Bitcoin short term is still a highly manipulated market, so it doesn't have the level of liquidity to short term not have mass manipulation in the market. But that's the same with many financial markets. If you're recording on a month-to-month basis, Bitcoin certainly isn't that short-term hedge. However, the play with Bitcoin is a long-term hedge. So that's really the way to think about Bitcoin. Short-term, you've got very, very wealthy people that own Bitcoin that put them in and out of exchanges, manipulate prices, and try and extract as many Bitcoin from those that are trying to get rich quickly. Bank to the Future, we launched our Retirement Plan B product, and we have never seen demand like it. The amount of demand for people to be able to hold Bitcoin and invest in this industry and sector, we've never seen anything like it out of all the products that we've launched. I think there's an upside and a downside to holding Bitcoin in your retirement. So one of the big benefits of Bitcoin is giving you the ability to own your own money, spend your own money, and have the money supply that's completely fixed. But when you hold it in your retirement plan, you're most likely going to need to do that via some kind of custodian, in which case you introduce some of the challenges with a traditional financial player. The good thing about holding it with a custodian as opposed to a bank is that they have a legal and fiduciary duty not to rehypothecate and reuse, but you're still holding it with a third party. So that's one of the first things to think about with Bitcoin. The other things to think about is you could go as simple as you want just by putting some Bitcoin. You'd probably have to open a special IRA or something in the case of the US, or other countries have things like self-invested personal pensions and SIPs. Or you can just do it outside of a traditional retirement plan. The main benefits is that you get the tax deferral, so that if you have gains, many people are considering the tax situation of Bitcoin now. But also if you're doing other more exotic plays, so some people want to not just own Bitcoin, but they want to lend some of their Bitcoin and receive yield. That would normally be taxed as income. But if you do it within a retirement plan structure, you can defer and really benefit from a compounded income effect. And then if you're doing things like buying equity in some of the companies, then a retirement plan structure, it has real benefits in terms of deferrals and really accumulating the growth and holding it long term, which is where the real gains have been in Bitcoin. Many people are trying to figure out the tax situation. One is different in every country, but it's starting to reach consensus. Just around the time when Bitcoin reached above $200 trillion as the market, the entire market reached over $200 trillion, governments really stopped attacking Bitcoin and started seeing it as a tax collection opportunity. It wasn't really clear in the early days how to treat it as tax. So there's a lot of people that are trying to figure out how to handle the tax situation. So it's really a force against the whole, won't governments just ban Bitcoin? Well, when there's a lot of money on the line for them, then they probably won't. So the way that Bitcoin is typically treated, I can't give tax advice, obviously you'd have to speak to your tax advisor, but every time you exchange Bitcoin for another cryptocurrency or a stable coin, or you put it into a DeFi contract, you normally create a taxable event for yourself. And most people don't consider the taxable events because the price of crypto is moving so fast, and if they're trading in and out, then they tend to not think about the tax till later. That's a big mistake, and one of the real benefits to not trading and just being a long-term investor. If you're lending out your Bitcoin, then you normally receive some kind of income. If you're selling, then it's normally treated as property and subject to a capital gains tax. And then when you start going more advanced, like doing things like leverage trading, the more complex you go with the product, the more complex the tax situation can be. So it's still the real advantage, again, is doing it in some kind of retirement plan and also making it as least complicated as possible. So you don't end up creating these multiple tax events and really start thinking about planning that. Yeah, again, Bitcoin is a 12-year bull market, the highest performing asset class in history and the highest performing investment in history. And in that, you get a lot of volatility. So if you're watching the day-to-day price, then you are going to feel fearful. And with Bitcoin, there's always a million reasons why it should fail. And so everyone's going to be telling you those reasons why it should fail. But really, when thinking about it, it's a binary bet. So you're not going to put your entire retirement plan into Bitcoin unless you're particularly inclined to think that way. But most people are putting a percentage. So the professional fund managers like the Paul Tudor Joneses, they started very conservative with 0.5%, and now they're pushing up to 5% of their portfolio. You have to think about it as a binary bet, really. Either the industry is going to completely fail. My belief and my investment philosophy is that it won't, and therefore it's not going to be worth much, or it's going to be worth many times more than it is today, because the investment thesis, if it becomes true, that Bitcoin creates money you can own, money you can spend, and money that has a fixed supply, is, from my perspective, worth a lot more than it is today. So you got to really cut out the noise and the day-to-day and think about where you think it's headed. And retirement plans are perfect for that because they penalize early withdrawals, and really it's thinking about it. So don't put your whole thing, is really the advice, but put a percentage of it and really think about it in terms of what goals you want out of it. It's the part of the high return, high risk part of the portfolio. To give sound financial advice, I'd need to understand more about your individual situation, your liabilities, what your goals are, how long till you retire, and all the usual things a financial planner would go through with you. But really, it's the way that I think about my portfolio is that with my retirement plan, I have a percentage that's allocated towards getting exposure to the growth of Bitcoin and the wider crypto markets. I have a percentage that's allocated towards US dollar traditional denominated assets, and also a percentage that's allocated towards gold and various other factors. But it's portfolio theory. It's a modeling out a series of outcomes. If you believe in things like Ray Dalio's or Seasons portfolio, then they model out for inflation, deflation, economic growth, economic decline, and you try and allocate 25% towards each outcome, so that whatever happens in the world, you're comfortable. The real challenging thing about today is what has traditionally been known as conservative has also become quite speculative. I would argue that one of the riskiest places to leave your money is at a bank right now, which most people have gone off for the mantra, cash is king. So it's a very complex environment to navigate, but there's a number of methodologies you could use, and we work with our clients to help them figure out exactly what's right for them with their goals.